Guys, what's up? There's been so much news on FTX, Alameda Research, and the entire collapse. And when I watched like the Twitterverse and what's going on Reddit, I feel like there's a hot take that's generally not correct. So let's take a moment and recap exactly what led to the downfall of FTX and Alameda Research by looking at the actual tokenomics of the FTX token called FTT. This was really the centerpiece that enabled FTX and SBF to get the Miami Heat's arena naming rights, get people like Steph Curry, Tom Brady, Giselle Bundchen to endorse FTX. It was the power of the FTT token, which is literally a worthless shitcoin, and I'm not exaggerating. So think about the tokenomics behind this very briefly. FTX has an ICO which pre-mines 350 million FTT tokens. If you look at like the analytics on Masari, it's kind of confusing, but the TLDR is that 70% of the total tokenomics went to investors while 30% went to FTX. This was actually a lie. And when you look at on-chain analytics, you see that about 80% or $22 billion worth of FTT tokens was in the treasury of FTX or an FTX affiliate. So, with that as the baseline, just think through this circular loop of minting money and burning money that I've called the infinite money loop. So the centerpiece of the FTX scam is the FTT token, which is controlled by FTX's treasury and by extension Alameda Research. So FTX pre-mined 350 million tokens, but it's not available to the general public. This is the difference between total supply and circulating supply. The total supply is the 350 million tokens that exist within the treasury. The circulating supply is the total available FTT tokens available to the general public for distribution to trade and do degen things like use as collateral for perpetual futures, which is a super popular activity on FTX. But anyway, FTX has a bunch of FTT tokens. They have a proprietary trading firm called Alameda Research. Alameda Research made a bunch of really bad investments related to GBTC, which is the Grayscale Bitcoin Trust that has Bitcoin, which is trading under its net asset value. There's an opportunity to arbitrage this trust by buying BTC, depositing it into the GBTC trust, receiving shares of GBTC in return. After the 6-month lockup window, you could sell the GBTC shares and you'd capture the premium, which is the difference in the net asset value versus the spot price of GBTC. That's what Alameda Research tried to do, and they were using FTT tokens as like the collateral to do that. FTX gives Alameda Research FTT tokens by participating in the ICO or loaning to them or giving it to them at a severe discount. This is all verifiable on the blockchain now. It's complete insanity. Alameda Research then takes the FTT tokens and uses that as collateral for US dollar denominated loans, think stable coins like USDC. This is wild. Whoever was the lender on the other side that enabled this disaster to happen deserves to have all of their money lost. I mean, how could you use the FTT token as collateral for US denominated dollars when it's literally a shitcoin with zero fees from the FTX exchange accruing to the token? It has no economic value. But that didn't stop these like lenders from giving Alameda Research US dollars, USDC, using FTT as the collateral. So now Alameda Research gives a lender FTT tokens, they get back US dollars. What do? They go to the Grayscale Bitcoin Trust, they get Bitcoin, they deposit it into the GBTC Trust, get shares of GBTC back, and then when the lockup period ends, they sell the GBT shares and then poof, make a profit. They repeat this process again where FTX gives Alameda Research more FTT tokens or loans it to them at a discount where Alameda Research again goes and uses the FTT tokens as collateral for US dollar denominated loans, and then again goes and buys Bitcoin, which is deposited into the Grayscale Bitcoin Trust, where they receive shares of GBTC in return, which they sell for a premium after the 6-month lockup period. This goes on in perpetuity during the last bull run. Alameda Research, FTX making a ton of money. So it worked until it didn't. What's important to call out is FTX was able to throttle the price of the FTT token using minting and burning mechanisms. And this is like the centerpiece of the Ponzi. So when FTX wants to raise money, they release more FTT tokens into the total circulating supply out of its treasury. This makes the circulating supply go up. When FTX wants to control the price of the FTT tokens, perhaps to maintain a certain baseline, not have it go below a certain price, they would burn FTT tokens, which usually means one of two things. Burning a crypto token is when you send the token to an unusable address where it can't be redeemed in the future. That's what people initially thought that FTX was doing, but I'm not convinced that's actually what happened because there's no proof of it. What I think it really happened and what like the data will unfold over the next months is that FTX would just buy back the FTT tokens, put them back into their treasury, but not removing it from circulation. It's just sitting in the treasury. It's like a share buyback. So if just to put this together, if FTX wants to raise money, they sell FTT tokens. If FTX wants to make sure the FTT token doesn't drop below a certain level, they burn or buy back the FTT token, which goes back to their treasury. That's it, guys. It's that simple. FTX creates an FTT token, sells it to the general public, gives it to Alameda Research for free at a discount. Alameda Research uses the FTT token as collateral to receive US dollars. They then use the US dollars to buy Bitcoin. The Bitcoin is deposited into the Grayscale Bitcoin Trust, where they receive shares of GBTC in return. After 6 months, they sell the GBTC shares. They receive US dollars in return, and it's a profit. This worked as long as GBTC traded at a premium relative to its net asset value. Uh, and it did in the last bull run. But during the last DeFi winter, which was only like 4 months ago, we saw GBTC move from a net asset value premium to a deficit. And like as of this video, GBTC is trading at like a 40% discount to its underlying asset, Bitcoin. So what happens in that scenario is the BTC that was deposited into the GBTC trust is now worth less than the actual Bitcoin. And the gotcha in all of this is it's a one-way ticket. When you deposit Bitcoin into GBTC, you can't get the Bitcoin back. All you can get is the underlying share, which is one share of GBTC, which is like 1/1000 of a Bitcoin. Sucks for Alameda Research, sucks for FTX, but if they just stopped there and said, hey, we made a bunch of bad investments and it went to zero, I think the crypto community might be more forgiving. What was really damning in all of this is FTX then decided to use depositor funds to continue to bankroll Alameda Research's bad investment decisions. And that's when things went off the rails over the past 3 weeks. It got the headlines on Twitter and CNN and MSNBC and blah, blah, blah. And that is what ultimately led to the downfall, which is the commingling of depositor funds to facilitate risky investments to Alameda Research. But again, the way it all started was using the FTT token. None of this would be possible without that worthless shitcoin. So keep that in mind as you continue to traverse through the Twitterverse and Reddit space trying to understand what's going on in FTX. The token, the commingling of depositor funds, that's it. If you like what you heard, hit the subscribe button. There's a really thorough analysis on the FTX collapse I wrote on frontruncrypto.com. If you want to read it, it's 3,000 words. I think you should. Just go there, search for how to steal $16 billion. That's the name of the article. It's super trending right now. I think you'll like it. Otherwise, thanks for listening. See you later. Bye.